So this is going to be the beginner guide to options trading. I'm going to be explaining to you all the basic terms that you need to know, strategies that you need to understand, and also how to set up and get the advanced tier for Robinhood so you'll be able to actually trade advanced trading strategies. So make sure you stay tuned, guys. I'm going to walk you through every single thing that you need to know about options. Let's go to the first thing we're going to talk about is, of course, we're going to learn about options. The first definition of options is going to be they are financial instruments that are derivatives based on the value of underlying securities such as stock. So if you get an option contract, offers you the buyer the opportunity to buy or sell the underlying asset. So if you get one option contract, that means you have 100 shares of that stock. Also, you also have the opportunity to sell 100 shares if you decide to sell the option contract. So that is the basic definitions of options. Now we need to learn about what is the purpose of options. The main purpose of options is to hedge portfolios. Like hedge funds, multi-billion-dollar portfolios, they use options in case there's going to be a market sell-off. If they anticipate or if they believe that there's something that might happen, they hedge their multi-billion-dollar portfolios with options. Now, the second thing is basically people use options, to speculate on earnings. The same hedge funds may make a trade anticipation of maybe Apple breakdown, things like that. Some of the traders, they use options in these hedge funds to basically make a trade. Now let's look at an example of a hedged position. Now on December 2nd, this article came out from Bloomberg talking about an S&P 500 put trade hedges $4.8 billion portfolio for a 4% drop. Of course, looking back at it today, we're actually in the new year. Happy New Year, everybody. That did not happen. We actually had a massive bull run coming to the new year. So that trade did not actually do well, unfortunately, but however, it only cost $32 million, but it was actually protecting $4.8 billion of assets. So hey, you know what, the risk reward, in case we had a sell-off, that would have protected all of these billions of dollars. Now the other and the famous way that people use options, of course, is to practice YOLOism, guys. If you never heard of the Reddit group, Wall Street Bets, you can go out there and you can go and check them out. They basically use options kind of like in a gambling way. So, they go all in, expecting, to make huge, massive returns. On the other hand, you can make also huge, massive losses. So if you're interested in that, you can go and check them out. Also, there's Wall Street Bets too, and they're fellow YOLOists, and they practice YOLOism. So you can go check them out to see what that Reddit group is all about. Now let's talk about calls and puts. If you believe an option is going to go up, you're going to buy a call options. You're going to make money as the underlying asset goes or trades to the upside. And if you buy a put options, that's going to be the opposite. You're going to make money as the underlying asset stock goes down. Now, the important thing that you need to know is strike price. Strike price is the price at which a put or call options can be exercised. So this is also known as exercise price. Let's look at an example. We're going to talk about it in detail in a minute, but this is the options chain for Bank of America right now, the January 3rd options chain, the 36 call, all the stuff in the white, 35.50, 35, 34.50 is going to be the contract, the strike price for the options contract that's going to be expiring in January the 3rd. Also for the put side, 36, 35.50, $35, 34.50. Now these are the strike prices. Now if let's say I bought a 34.50 call contract over here, that is for $75 or 75 cents, and if I decided to exercise it, that means I had one contract. When I actually decide to exercise it, that means I'm going to be buying the stock for $35.50, no matter if the stock is trading at $35.26. You see the current price is at $35.26, But since I have one contract that says I can buy it at $34.50, then I'll be able to exercise it and buy it at $34.15. So this is the exercise prices that you're looking at. So if you own this contract for 35 strike price, that means you'll be able to exercise it and own it, no matter if the price goes to 37, 38, $40 Bank of America stock, you still have the right to exercise it at $35. Also for the put side, is also at the same. Since you're buying a put, you can do the same thing on that aspect too. Now exercises, you get to buy, sell the options at the agreed price. That means when you get exercising, so exercising at stock options means purchasing the issuer's common stock at the price set by the option grant price, that means option seller, regardless of the stock price at the time you exercise the option. Assignment. Now this is important if you are somebody that actually practice selling options. We're going to talk about later on strategies that you can use to sell options. On this case, when a person actually decides to exercise the options that they've got, the seller will be assigned to fulfill that contract. So the option sellers must fulfill the obligation of an option contract by either selling or buying the underlying security at the exercise price. The exercise price is the strike price. So when you get assigned, you have to fulfill that at the strike price of the contract. Now, in the money versus out of money. Now, this is an important, a term that you need to understand. So for call options, it's said to be in the money if the underlying stock is above the option strike price. Let's look at an example. This is Bank of America options chain. It's going to expire January the 3rd. The current price is $35.26. Now, the strike price is below the underlying current price that is being trading right now. So the strike price is below that price. So this is going to be in the money. That's why the price is kind of higher compared to when you look at 0.82, because the underlying stock is at $35, is trading above the strike prices. So these are in the money. So that is the case, and the one, as you can see, the 35.50 is out of the money because the underlying stock is trading below the strike price. You can check it, you can share, you can open up other options chain, and if the underlying stock is trading above the call contract, then that means the strike prices are in the money. If it's below them, they're out of the money. So the below them are in the money, above them are out of the money. Now for put options, it's going to be the opposite. If the underlying stock trades below the strike price, then that's going to be in the money. Let's look at these. Bank of America put options, right? The underlying stock is trading at $35.26. Now the underlying stock is trading below the option strike price. That means these $35.50 put strike price is above the underlying stock, so this is going to be in the money. And the one that is going to be trading below the $35.26 is out of the money. However, if Bank of America, tomorrow when the market opens, sells off to $35 or $34.90, this 35 put strike price put is going to be in the money because the underlying stock is trading below the strike price. This is going to be, so for the put side, it's the opposite. For the call side, it is going to be the opposite. Now, what is option premium? Option premium is the price paid by the buyer to the seller for an option contract. Let's say you hear somebody talk about, wow, I placed a trade, I traded an amazing trade last week on Bank of America and I collected a lot of premium. Based off that statement, you can tell that the person that said that statement actually sold option contracts because he said he collected a premium. So the seller collects premium and the buyer is actually the one that is providing the funds, to execute the trade. So option premium is the amount of money that is exchanged between the buyer and the seller. So let's look at the premium price over here: 0.01, 0.08, 0.03, 0.75. This is like the premium. If the seller, if you actually decide to buy it, you're going to need $33.33. Basically, you have to multiply by 100. And also, if you want to buy the put over here through 12, so the seller is going to receive that money, and he's going to be like, oh, I received $33 premium from this trade. Yeah, he will be able to say that. Now, the break-even point. The break-even point is the market price that an underlying asset must reach for an options buyer to avoid a loss if they exercise the options. Now, this is an important point because this is going to determine if you're going to if you can become profitable or not. So you're going to calculate for call options. What you're going to do is you're going to add the strike price plus the premium paid, or the amount paid for the option contract. For call per put contracts, you're going to subtract the strike price minus the amounts paid. Let's look at these. So we got 30 for call options, $35.50 is the strike price. If we decide to buy it, we are going to, in order to calculate the break-even price point, $35.50 plus 0.08 is going to give us $35.58. In the Robinhood shows you that right over there. And for the put options, you got $35.50. You need to subtract the amount that you paid, 37 cents. So 0.37 cents. You subtract it, you'll get $35.13. Robinhood will show you that over here too. For the put side, you subtract the strike price minus premium you paid. For the calls, you add to get the option premium price, the break-even price. Okay, options collateral. Now, this is important if you are actually an option seller. The option seller needs to have the underlying stock or cash as collateral to make sure you can cover the position in case of an assignment. Now, this is important. If, let's say, you sell a contract and that person decides to exercise you, that means you need to fulfill that. Especially if that's in the money, then you're going to take a loss if you get assigned. So in order to cover that, that's why the broker will get cash, and you need to hold the underlying stock. Important. Option collateral important. This is sell to close. Sell to close is going to be you transfer the right to exercise to a new party. When you're actually swiping up and just closing out your options for a loss or for a gain, you're transferring that obligation to exercise, or that right to exercise, that's the right to exercise to another person. That's important. So you're just closing it for profit or for loss. That's what it means when you sell to close it. That is basically what that means. Expiration. Now this is important. Once an options expire, it is worthless. It's not going to have any value. So when you're actually going to buy an options, you need to pay attention to if it's a weekly, if it's going to expire in a month. If there is a lot of time on the options contract, the price is going to be higher. However, if it's going to expire in Friday, if it's a weekly option, it's going to be cheap. Don't be like, oh man, it's cheap, I want to buy 100. Don't do it. Okay, so let's look at it. So we have January the 3rd over here. This is going to be the expiration. January the 3rd, January 10, January 17, January 24, January 31st. It's the same goes to the bank for the put side to the expiration over here. The Greeks. Okay. The Greeks is what? We've got Delta, Gamma, Vega, and Theta. And that was all I forgot. There's one more. Both provide you a way to measure the sensitivity of an option price to quantifiable factors. So off of all of these Greeks, we're going to focus on Theta because this is the most important one that we're going to talk about. This is the measure of time decay. As we know, options contracts is going to be worthless at the end of the day if the contract doesn't go in the money. So if the underlying stock doesn't go up or it doesn't go down, if you have a put, if it decides to just stay in the same place after you bought it, as time goes by, that contract is going to lose value, and Theta is going to be the one measuring that. So it's going to measure that. You're going to check that. If Theta is high, then man, your contract is going to lose value. Now we're going to look at a practical example. There's going to be a video showing you guys exactly how to buy call, how to buy options. This is important. Watch it. America is currently trading at $35.26. After analyzing the chart, I believe that the stock is going to go to $35.52. That is the high that it made on the 3 months chart. So I want to place a trade and go to options and open a call contract with a strike price of $35.50. In order to do that, I'm just going to click on January the 3rd. That is going to be the expiration date. And there's also options for January 10, January 17. And I'm going to click on the strike price, $35.50. All of these whites, the prices in white are the option strike prices. And on the right side are the premium that you need to either, if you're buying, you have to pay, or if you're selling, that you're going to receive when you are executing your trades. So in this case, I'm going to buy the $35.50 because I believe Bank of America is going to go to that price. And the contract, how many contracts I want to buy is I'm going to buy one. As you can see, every contracts times 100 shares. So if I buy 2 contracts, that means it's 200 shares. And below it says the limit price is 0.07. That's the bid, and 0.09, and that is the ask. You can click on it to see in detail the stats of the option contract. So the high was 0.10, and the mark is 0.8. The bid 0.7. Volume, you can see 6,894. That's the amount of contracts traded back and forth. And the open interest, there are currently 10,103 contracts open with this current strike price that we're looking at. And the implied volatility, 13.43%. We're going to talk about that later on. And the break-even price for this contract is going to be $35.58. As we talked about, you can calculate the break-even price by adding the strike price plus the premium that you paid. That is going to give you the break-even price for your call contract that you're going to buy. And it also shows you the chance of profit, which is going to be 23.24%. And the Greeks, as we can see over here, the theta is minus 0.025. As time goes by, the contract is going to go down. So we're going to go back over here. I'm going to click on the right. And Robinhood tells us that you're paying $8 for the right to buy 100 shares of Bank of America for $35.50 per share by January 3rd. If Bank of America shares are not $35.50 or higher on January 3rd, this option will expire worthless. So that is a very clear and precise explanation from Robinhood. Also needs to go to the break-even price for us to make any kind of profit. So let's swipe it up, and we placed our trade. I'm not going to swipe it up because I don't want to make a trade right now. Now let's go back, and I'm going to show you how to open a put. That means let me analyze the chart of Bank of America one more time and see what it can possibly go. So that is the 3 month chart that we just looked at. Let's look at the weekly chart. So the weekly chart is Bank of America was trading at $35.06. The low that it made is $35.02. So I believe, let's say I have a thesis that say that Bank of America is going to retest the lows. Then I'm going to go to trade options. I'm going to open a put contract. That means you're going to make money when the stock goes down. So you're going to click on that one. Go to January, or you can go down the top over here, put. And what do I believe? I believe the stock is going to go and retest the lows, which is at 35.02. So I'm just going to buy the 35 put over here. One. And I am going to click on the limit price to see exactly the volume, which is 2,974. That's the amount of the contracts traded back and forth. The open interest is 15,007. Implied volatility 18%. Chance of profit 25.25%. The break-even price for put contracts is going to be the strike price minus the premium paid. So we're going to pay $35. The strike price is $35, and we're going to subtract the premium that we're going to pay. In this case, it's going to be $12, 12 cents, right? So we're going to subtract 35 minus 0.12 cents. It's going to give us $34.88. And also you can look at the Greeks over at the bottom. You can go back over here. I'm going to buy one contract. And Robinhood explained to you, you're paying $12 for the right to sell 100 shares of Bank of America for $35 per share by January 3rd. If Bank of America shares are not $35 or lower on January 3rd, this option will expire worthless. So you're going to swipe up, and that is going to execute the trade for you. Another tool that you can use is you can go to Options Profit Calculator to see exactly your chances of profit as time goes by. Let's go to Options Profit Calculator. You have to click on Home and go to the calculators. There's out on the tab, you click on the calculator, and it's going to, you have to pick the Bank of America symbol. You put a Bank of America symbol over there. You click on get the price. It's going to show you the exact price, the current price. And since we're buying a call contract, we're going to click on Select. The right side is going to, the left side is going to be the call. The right side is going to be for the put. On the top side, it shows you the possible expiration date you want to pick. So we can pick the January 10, February 21st, but we're going to focus on the 3rd of January. And we believe Bank of America is going to retest $35.50. So I'm going to click on that one. We're going to buy one contract, and we are going to calculate. You click on, after you're done, you can click on calculate. It's going to show you your break-even price is going to be $35.58, and your maximum risk is going to be the premium that you paid, which is $8. That can go to zero if the contract expires worthless, and maximum return is going to be to the upside is unlimited, theoretically. So you can scroll down over here. So January 3rd is going to be the expiration date. So you can click on it. If Bank of America goes to $35.40, I'm not actually going to make money. I'm going to lose that because it's not above that strike price that I paid, the break-even price. However, if it went to $35.60, I'm going to make $2. So because it went above the break-even price of $35.58. Now let's look at for the put contract. For that, you're going to click on Select, go to the right side. Since we believe we have a thesis that the price the put contract is going to go down to $35, we're going to click on 0.12, and then we're going to click on Calculate. That is going to show us our maximum risk is the premium, or the price that we paid, and the maximum return is going to be $3,488 because it can go to zero at price of zero. That's theoretically, if Bank of America just collapses and goes to zero, that's going to be the maximum profit we can make. And the maximum risk is $12 at the price of 35 cents. That's the strike price that we paid. If it doesn't do anything, that's the maximum that we're going to lose. Now let's look at the projections. So if Bank of America goes to $35.10, we're still not going to make any money. Zero. If it goes to $35, you're still not going to make any money. $4, okay, we made $4. And if it goes to $34.90, you make $16. Since the break-even price is $34.88. How do we calculate the break-even price? We subtract the strike price, going to be $35 minus 0.12. That is the premium that we paid. You're going to get $34.88. So that is how you're going to use the options profit calculator just to see your projections for the contract till the expiration date. Now, in order to set up for Robinhood as advanced tier, you're going to be able to have experience. You have to place a few trades, 1 or 2 trades, and just pick up a company that is not super volatile, like a bank stock. As I mentioned, the Bank of America, you place that trade and you're able to come reapply, and you will get the advanced tier. You'll be able to buy, sell, clear spreads, exercise options, and all the other fun stuff. You need it, important. Then you have to go, and we are going to learn about the awesome strategy, the data gang Vertical spreads. Now, this is an important strategy that you can use. These are less risk, less reward. However, since you're a beginner, this is important. This is a strategy that you want to implement. That's strategy that I implemented. So there are 4 spreads. The first one is a call credit spread. This is the bearish position. You're going to get it if you think the underlying stock is going to go down. And then the put credit spread, you're going to buy it if you are bullish. You're going to get it if you seeing the stock go up. And you're going to go a call debit spread if you think it's going to go up too. A put debit spread if you think it's going to go down. Let's talk about the call credit spread. Now, this is a strategy that you can use to make money if the stock price stays the same or go down within a certain time period. Now, when you're placing a credit spread, either a call or put credit spread, you will always receive a premium. What did we say premium is? Premium is the amount that you will receive when selling an option. The amount of money you receive on selling an option. So selling and buying call contracts, what call credit spread is simultaneously selling and buying call contracts with different strike prices but the same expiration date. So since we're buying and selling, we have 2 legs. There's a higher leg, the upper leg, and the lower leg. So you can call it the higher leg or the upper leg, and the lower leg. So for a call credit spread, we're going to buy the higher strike price to protect our downside, and then we're going to sell the lower strike price. So that's going to be the one that's going to make us the money. Let's look at an example. We're looking at Bank of America options chain. I believe Bank of America is going to go down. That's just an example. So if I believe that, I'm going to buy the 35.50 strike price to protect my downside in case Bank of America goes to the upside. This is going to be the one that's going to mitigate my risk, and this is going to be the one that's making you a profit. If it goes down, the $35 call is going to lose value if it goes out of the money, and if both expire worthless, I'm going to collect all of the money that I received from selling the contracts, collect all the premium. So call credit spread, limited risk, limited reward, capped gain, capped loss. Your maximum profit you're going to get is going to be the premium that you received after you sold those contracts, and you're going to get the maximum profit if it goes below, if the underlying asset stock trades below or goes below the lower strike price. This is the lower strike price, right? 35 call, that's about 35 strike price. The higher is 35.50. So if it goes below 35, you're going to make you become Gucci, man. You're going to start flexing on us with your profit. Okay, maximum loss, upper strike minus lower strike minus the premium received. Let's look at an example. We are going to place a trade. We believe that Bank of America is going to sell off. We buy the 35.50 to protect our downside. We sell the 35.50, which is in the money, to collect the premium. So the maximum profit is going to be 0.25, which is $25. You multiply 0.25 times 25. This is going to be the maximum, and the maximum loss you can calculate it by subtracting the higher strike price, the upper strike price, which is $35.50, minus the $35, the lower strike price. You subtract the premium received, is going to be 0.25, and then you get 0.25. You multiply this by 100 and you will get $25. So this is the one-to-one trade. This is, you make money, you lose it. It's like a flip a coin, a one-to-one. That is going to be the case, right? So you place a trade on a call, either call or put credit spread. The maximum you're going to receive the maximum profit instantly when you place the trade. So that is it. The break-even point for a call credit spread is going to be the lower strike price plus the premium received. Let's look at it. The breaking point is going to be the lower strike price over here, which is $35, plus the premium is going to be 0.25. This is going to be the break-even price for this option trade, this spread trade. We're going to look at a practical example. I'm going to show you exactly how to place that trade. We also look at options private calculator to help us see the projection of our trade. Open a bearish position on Bank of America using a call credit spread. First thing I want to do is I'm going to click on trade options. I'm going to go to the expiration date that I want to open. I want to open for January 3rd. And I'm going to click on the top right corner. It says select. I'm going to click on select. And I'm going to get the higher strike price. I'm going to pick $35.50 to $35.50. That is going to be the one I'm going to buy. And then I'm going to click on sell. And then I'm going to sell the 35 call strike price, which is currently in the money. I'm going to click on it. And then it's going to, just going to show us we're going to buy 35.50. We're going to sell the 35 call, and the total credit is going to be 0.25. This is just basically going to be the difference between those 0.8 minus 0.33. Going to click on continue, and we can click on 2, 3, 4. Then it's going to increase the credit that we're going to receive. But on this example, I'm only going to get one contract, and the limit price currently is 0.25. And I'm going to click on right over here, and this shows us the collateral. The collateral is the amount of money the broker sets aside in case our options get assigned. So we bought, we sold one contract, which is $35, which is in the money. So in case that gets assigned, our broker needs to set aside the collateral needed for that case. So the maximum amount of money required to place this trade is going to be the collateral that you have over here, $50, minus the credit you receive, which is $25. Since we collected a premium of $25, we can use that to cover to open this position. So you're going to need $25 to open this position. Now, in order to project and see what this position can possibly make us, we can go to profitoptionscalculator.com. Let's go right there. Gonna go to that website. On the top corner, it's going to show you a calculator. You're going to click on the spread side, and you're going to click on credit spreads, and then you're going to type in over here the Bank of America symbol, which is going to be BAC, get price, and you're going to buy the long. What we're going to buy, remember, we are buying the higher strike price. Upper leg is going to be a higher strike price, so we're buying the $35.50. We're writing, that means we're selling. That's another word for selling. So we're going to click on select options, and this one's going to be the lower leg, the lower strike price. It's going to be $33. In this case, it's kind of in the money. So this is going to be the net credit that we're going to receive. We're going to click on calculate. It's going to show us the break-even price, and also our maximum profit, our maximum loss. The maximum risk is going to be $25, which is going to be calculated by the upper strike price minus lower strike price minus the premium received. That's going to give us the maximum risk. And the maximum return is going to be $25, basically, because that is the amount of premium they received, and the options expire. We're going to collect the $25. Now let's look at the projection of the stock price. So if Bank of America goes to $35.10, make $8. Since this is a bearish position, we're making money as the stock price declines. So we got $34.90, make $17. Our maximum return is going to be $25 at a price of $35. So if the options expires at $35, we're going to make our profit. Let's look at over here, 12. The price needs to go, the stock price needs to go below $35 for us to make, or it needs to be at $35 for us to make a profit. It needs to get below the lower strike price. This is going to be the lower strike price, is $35. So that is in simple how you can use the options profit calculator to see exactly your maximum risk, your maximum return, and your break-even price, and to see the projections. Now let's look at a put credit spread. This is a bullish position. You're going to make money if the stock stays the same or goes up. So you're simultaneously selling and buying put contracts with different strike prices but the same expiration dates. When you place this, you're going to receive a premium. Now, this is going to have two legs, as I mentioned. There's going to be a higher, the upper, and then the lower strike price. So the maximum profit is going to be when both contracts expire worthless, when the underlying stock trades above the higher strike price. That is the time when you're going to be like, I'm Gucci, baby, I'm Gucci, I made profit. Let me post it on the Twitter, Reddit, oh, let's do it. Max loss, upper strike price minus lower strike price minus the premium received. Let's look at an example, right? To place a trade, you're going to have to buy the lower strike price to protect your downside, and you're going to sell the higher strike price to make a profit. You place a trade, receive the maximum profit. The break-even price over here is going to be the higher strike price minus the premium received. Let's look at it. So we are going to place a trade. We're going to buy the 35 put option, and then we're going to buy the 34.50 put options, and we're going to sell the 35 put option. So with this transaction, the minimum amount that the maximum amount we're going to make is going to be 0.08, which is going to be $8, and the maximum loss is going to be the difference between the upper strike price, the lower strike price, minus 0.08, which is the limit price. It's going to give us 0.42, multiply that by 100, so that's going to be the max loss. An easier way to calculate your max loss is going to be $50 minus $8, it can give you $48. That is all. This is not a good trade, man. You are risking a lot, man. $42, that is a lot. The practical example is going to show you exactly how to place a trade. We're also going to look at options profit calculator to show us exactly how to do it. We're going to be opening a put credit spread. That is a bullish position. I believe the Bank of America is going to go up by the end of this week. In order to open the position, I'm going to click on trade options. I'm going to click on the expiration date that I want to open the contract for. I'm going to click on January the 3rd. On the top right corner, it says select. I'm going to select that. And for the call or put, I'm going to go for call. And the first thing I want to do is I'm going to buy the contract first. So since I believe Bank of America is going to go up, it's going to continue to go up by the end of this week, I am going to buy the protection first, which is going to be the lower strike price, the $34.50. I'm going to buy that, and I'm going to sell the higher strike price, which is going to be the $35 put. I'm going to click on that. That is going to show me the put credit spread price. Now I'm going to continue. Now the maximum profit that I'm going to make off of this trade is going to be 0.08. You multiply that by 100, you get $8. You get that price, 0.12 minus 0.004. The minus indicates that you're selling it. That's why it's saying minus. Now we're going to click on continue. I want to buy open one contract. Since $8.50, I need to make it to update it to 0.08. It needs to be 1 cent increments. Now it's saying the collateral is going to be $50, and the minimum credit we're going to receive is $8. So the maximum I can make is $8, and the maximum I can lose, you can calculate that by subtracting the higher strike price, 35, minus the lower strike price, $34.50, and you subtract the premium that you received, which is going to be $8. It's going to give you 42 cents. You multiply that by 100, and then you're going to get $42, right? So the easy way you can calculate the maximum loss is also you can subtract the total collateral needed to place this trade. 50 minus the minimum credit that you're going to need is going to be $8. In order to place this trade, you're going to need $42 because he received $8 of premium. That can cover your collateral in a good way. So that is going to be it. Now let's look at optionsprofitcalculator.com to see the projection performance of our position Now let's look at option profit calculator over here. You're going to click on the calculator, click on credit spread, click on credit spread. You're going to scroll down. You're going to click on BAC, get price. It's going to get the current price that Bank of America is trading. On the long part, we are going to select the option. We're going to go to the put side, which is on the right side. On the top, we're going to select the date that the contract is going to expire. It's going to be on the 3rd of January 2020. And since I am going to buy the put contract that's going to protect me, that is going to be the $34.50. I'm going to buy that. That's going to protect me. And then I'm going to sell the option contract that is going to make me money. So that's going to be right. I'm going to select that. And I'm going to select the $35. The net credit received, the net premium received is going to be $8. That's going to be the difference between 0.04 minus 0.18. And then you're going to click on calculate. And that will show you the break-even price, the maximum profit, the maximum loss. And you can also see your projection price point profit as the trade continues, as the stock continues to trade. So it says the maximum risk is $42 at a price of $42.50. That is the lower strike price. The maximum return is going to be at a price of $35 or above that. You're going to make $8. The break-even price is going to be $34.92. And how you calculate that price is going to be, you're going to subtract 35, the higher strike price, which is 35. You're going to subtract the credit that you receive is going to be 0.08. 35 minus 0.08 is going to give you the break-even price of $34.92. And as you can see, as time progresses, if the stock continues to go to the upside, we're going to be making money since it's a bullish position. This is a put credit spread. This is a bullish put credit spread. So we're going to click on that one. You can see we're making $7. The maximum we can make, even if the stock goes to $36.90, is going to be $8. And also the maximum that we're going to lose if it goes against us is going to be higher, because it's going to be $42. Since we're risking a lot in this situation, right? However, the chance of Bank of America going below $34.50, the stock needs to sell off hard. So there might be, a lot of people like to do this kind of trades where there's not a lot of probability that the stock's going to sell off that much. So they keep doing this kind of trades over and over again. And that one time that it doesn't work out, they get all the maximum collateral taken out, which is going to be $42. And you end up, losing the majority of the profits that you collected. So that is not, sometimes it's good to do it, sometimes not good to do. So you just got to be aware of doing the strategy, especially if the risk is super, super high and your return is like very low compared to the risk that you took. Now, let's talk about call debit spread. This strategy is used if the underlying stock go above within a certain time period. So you will make money if it goes up to the upside. You're simultaneously buying and selling calls with different strike prices but the same expiration dates, just like the other spreads. You have two legs, upper and lower. In this case, since it's a debit, you're going to pay premium. You pay premium, man. There's no free thing. You pay. The call debit spread. The lowest strike price is going to be the price you think the stock will go above, and the higher strike price will be the same thing. The maximum price the stock can reach in order for you to keep making money. Once price passes this price point, no longer making profit. Oh, sad. This sucks. I don't like debit spread. I just buy the call. That's what people say. However, there's occasions where you can't afford the option strike price premiums, so you have to use a debit spread. Let's look at an example. If I believe Bank of America is going to go to $36.50, if it goes above that point, if it goes to, if I believe it's going to go to $36.50, then this is, I can place a put a call debit spread. The call debit spread, sorry. So I buy $36 and then I sell the $36.50, the maximum profit is going to be the upper strike price, the lower strike price, minus the premium received. Only if the stock is at or above the higher strike price at expiration, you're going to be Gucci. You're going to make the maximum profit. The max loss you're going to lose is going to be the premium that you paid. So the break-even price point, let's just refresh what a break-even price point is the price the stock needs to reach when your contract expires so that you don't lose or make money on your investments. So the break-even point for a call debit spread is going to be a lower strike price plus the premium paid. Let's look at it. So we bought the 36 call, we sold the 36.50. The maximum loss is the premium that we paid, which is 0.14, $14. The maximum profit is going to be $36.50. It's actually, so it's supposed to be, $36.50 minus 36 minus 0.14. It's going to give us 0.36. You multiply by 100 and get you $36. This is not bad today. This is good. This is a good today. Good that is the worth, 14 to make, that's a good rate. Break-even price is going to be 36 plus the credit received. 0.14 is going to be $36.14. That's how you calculate it. This is the lower strike price and the premium received. You're going to look at a practical example of me placing this trade, and also we're going to use options profit calculator to see exactly how to see the projection. All right, so now I'm going to be opening up a call debit spread. After looking at the monthly chart of Bank of America, I have a feeling, or I have a thesis, that Bank of America can go to $36 by January 17. So in order for me to place that trade using a debit spread, I have to click on trade options, and go to the call side and pick the expiration date that I want that the contract is going to expire. Is going to be the January 17. The call side, I'm going to click on the buy. On the top right corner, you're going to click on select. Since I believe Bank of America is going to go above that price, I am going to click on $36, and I'm going to sell the $36.50. And then I'm going to call debit spread. So now we are buying the 0.36 and we're selling the minus 0.22. So we actually have to pay a premium of 0.14, which is $14. So the lower strike price, $36, is the price that you believe that the stock will go above by January 17. Also, the higher strike price, $36.50, is the maximum price that you believe the stock can reach in order for you to keep making money. However, if it goes above $36.50, your profit is going to get capped. So that is going to be the thing with a debit spread. We're going to click on continue. I'm going to buy one. We have the limit price over here, which is 0.4, which is actually is kind of wrong. It should be lower, but we're dealing with Robinhood, so it needs to update to 14. So as you can see over here, we do not have a collateral required to place this trade because we are using our own capital to place this trade. Now, in order for you to calculate your maximum profit, is going to be, you're going to subtract the higher strike price, which is $36.50, minus the lower strike price, which is $36, and then you're going to subtract the premium that you paid, which is going to be 0.14 cents. The total is going to be 0.36. You multiply that by 100, you will get $36. That is going to be your maximum profit. And the break-even price for this trade is going to be, you're going to pick the lower strike price, which is going to be $36. Then you're going to add the premium that you paid, which is going to be, or the limit price, which is going to be 0.14. It's going to be $36.14. Now let's go to optionsprofitcalculator.com to see the projection profit for this trade. Going to go to options profit calculator. As you can see over here, you're going to click on calculator, click on spreads. You're going to select the options, and you're going to select the option. So the contract that we picked is going to be for January 17. That's going to be the expiration date for that. And we are going to buy that $36 call, 0.36, and we're going to sell the $36.50, which is below it. I'm going to close on that one. One contract 0.36, 36.0.2. So the net debit is going to be 0.14, which is going to be in red, which is minus. So that means you're going to be required to pay this amount of money to place this trade. So the maximum risk for this trade is going to be the premium that you pay, which is $14. It's going to be the maximum loss that you're going to take. And the price point is going to be $35.20. That's going to be the max risk. The maximum return you can make is going to be when the stock price goes to $36.50, and the break-even price is going to be $36.14. You calculate that by adding the lower strike price, which is $36, and the premium that you paid, which is going to be 0.14. It's going to give you $36.14. As you can see, if the Bank of America stock goes up, we're going to be making money since it's a bullish position. This is a call debit spread. And if the price goes up, so we need the stock to go down. Even if it doesn't do that much, we're not going to be losing that much. So theta is not going to hurt us that much. So let's see if it goes to 37, 35. Let's see over here, 35.90. Let's see our maximum. We can make $5. So if Bank of America goes to 36.40, 13. So you can look around and see what is your projection profit. Also, if Bank of America starts to lose to go to the downside, you can look at your downside to minus $7. So that is a call debit spread. Projection of the trade. Let's look at a put debit spread. This is a bearish position. You're going to make money if the stock go down within a certain period of time. So you're simultaneously buying, also selling put options with different strike price, but the same expiration date. In this case, you're going to pay premium. If you're using debit, you'll pay premium. You'll pay no free lunch here. Put debit spread. Two legs, upper, lower, higher, lower. The higher strike price is the one that you're going to pick if you think the stock is going to go above. The stock is going to go, the stock is going to go below. If it fell below more, maximum profit. If it go down, awesome. The lowest strike price is going to be the minimum price the stock can reach in order for you to keep making money. Let's look at how to place a put credit spread. A put debit spread. So we're going to buy the 35 put option, and then you're going to sell the $34.50 put option. The maximum profit that you're going to make is going to be the upper strike price minus the lower strike price minus the premium paid. The maximum loss is going to be the premium that you paid for this stock. Let's look at it. The maximum loss is going to be $14. The maximum profit is going to be $35. The higher strike price minus the lower strike price, $34.50, minus premium. The receipt is going to be 36 times 100. It's going to give us $36. The break-even price is going to be, you're going to pick the higher strike price, 35 minus 0.14 is going to give us $34.86. We're going to look at exactly how to place a put debit spread. Bank of America is currently trading at $35.26. If I believe that Bank of America stock is going to go down and I want to use a spread position to capitalize and make profit, I'm going to go to trade options. I'm going to click on the expiration date. So I believe by January 10, Bank of America is going to go down. So I'm going to open a put debit spread that is going to expire in January 10. On the top right corner on top, we can click on select. And I believe the Bank of America is going to sell off. It's going to go below $34.50. by January 10. So what I'm going to do is I'm going to buy the $35. I'm going to sell the $34.50. That is going to create the put and debit spread. I'm going to scroll up, and then it's going to show us that we're going to be required to pay 0.14. That is going to be the premium that we need to pay. And let's click on continue. The limit ask, the bid and the ask, 1 of 14. click right. Now we don't require to have a collateral to place trade. So the maximum loss I can take is going to be the $14 if Bank of America does not sell off. Also, the maximum profit that I can make is going to be the higher strike price, which is going to be $35 minus the lower strike price, $34.15. I'm going to subtract that from the premium 0.14 or the limit price. That's going to give me 0.36. I multiply that by 100. So the maximum that we can make is going to be $36. Also, the break-even price is going to be calculated by subtracting the higher strike price, $35 minus the 0.014, the limit price with premium price. Is going to give us $34.86. Now let's go to options profit calculator to see the projection of how our position is going to do. You're going to click on a Bank of America, select options, and the expiration date that I put was going to be January 10, the 10th. So it's going to be the put. So I buy that $35 and then I sell the $34.50. I already clicked on it, so I don't have to click anything right now. Everything is in place. So you're going to, for the right, this is basically the selling part. So you're going to click on select. And this is the one that you're going to sell. So make sure that the expiration date is for the January 10th. So you're going to click on, the $34.50. That is the one that I sold, so you click on that one. Everything is placed ahead of time. So the debit is going to be 0.14. It's going to be $14. The maximum risk is going to be $14. The maximum return is going to be 36. As I mentioned, you subtract the strike prices and then subtract, the debit, the premium that you pay, 0.14. Now the break-even price is going to be the higher strike price minus, 0.14. That is going to give us, as you can see over here, if Bank of America continues to go down to the downside, we're going to be making money since this is a bearish position. This is a put debit spread. And as time continues to go down, the expiration date is at 10. So if Bank of America eventually goes to $34.60, could possibly make $16. Now the maximum risk is 14. So this is actually not a bad trade. This is like 14 to 36. However, Bank of America doesn't move that much. So if it sells off, it can potentially go to, $34.50. So this is actually not a bad trade to place looking at the risk to reward. So that is for the put debit spread. Bonus tips. If you are going to be selling options using spreads, credit spreads, and put credit spreads and call credit spreads, if you go and end the money, you're going to receive more premium. However, there's a risk of you getting assigned. And also, you have to be really careful because if the underlying stock is expected to pay dividends, and if it's expected the ex-dividend date is approaching, Robinhood is probably going to close you out. But if Robinhood doesn't close you out, you're going to be responsible for paying the dividend of the amount of options you have. If you have one options, you have to pay $100 shares of dividends for that company that you're holding. So you got to be really careful about that. Out of the money also, this is a great strategy. If you're selling out of the money contract, collecting premium, it's not going to be a lot of premium. However, that one time that it doesn't work out, it's going to destroy you. You're going to get destroyed. You're going to get crushed. You're going to get caught with your pants down. And you're going to be like, what the heck happened? That is not good. So you have to really be careful. So make sure that you actually analyze the trade and be really careful, my friend. Be really careful. Now, this is going to be the most important thing. If you make it to this part of the video, man, congratulations. You made it. If you understand this concept, you're going to make a lot of money. Just joking. But yeah, the mindset. This is really, really important, guys. The way that you approach this thing is going to be really important. A lot of people will get into options, to make a lot of money. So they become offensive. They go aggressive. They probably YOLOing a lot and things like that. However, you need to be, since you're a beginner also, you need to approach it as defensive. You need to take it one step at a time. Paper trade. Make sure if you don't understand anything, ask questions and really, really pick a strategy that is going to not make you a lot of money, but also that's going to protect your downside. Because at the beginning, you're going to make a lot of unfortunate errors. Unfortunate errors is going to be there. A great example to talk about that I'm going to explain to you guys is just like in tennis, guys. Even the professionals, on the right side, this guy's called Novak Djokovic and the other guy's called Roger Federer. So Novak Djokovic has the best defense and has been the world number one and is named as the greatest tennis player of the past decade, the 2010 to 2020. So because he has a very, very solid defense and he doesn't make a lot of errors. However, if you look at his game, he doesn't hit a lot of winners. He has a fantastic defense and he makes his opponents play super aggressive. So when they play super aggressive, they make unforced errors, even though they hit winners more than he does. But at the end of the day, since his defense is solid, his return game is solid, they end up losing. They make unforced errors. So that is what you need to do, So when you're actually placing lots of trades, when you play aggressive, when you're placing trades, sizing up a lot, your potential to make unforced errors is going to be high. Even if you make a lot of profit, you're more than likely not going to win at the end of the day. So pick a strategy. Don't just go all in, YOLOing, all that kind of fun stuff. Even though it's fun, don't do it, man. Don't do it. If you have YOLO demon, go, I pray for you, okay? Go join the Discord, I pray. And the other thing is also, since you're going to be a beginner, if you look at a beginner tennis player also, they're going to make unforced errors, right? They're going to make, of course, everybody's going to fail the first time, right? Trying to play tennis because it's kind of hard too. So you're going to make unforced errors. However, you're going to get better as time goes by. That's why you need to practice paper trade. When you trade with real money, sometimes you don't know if you place the bullish position or bearish position. What is the credit spread? What is the mass collateral? Oh my goodness, you'd be like freaking out. Oh God, what happened? So if you don't want to be in that position, paper trade, understand the strategies first. And if you understand the strategies perfectly, then you move on to a small account. Small account is super hard. Small account is going to be just like going to war with one bullet, because you don't have a lot of capital. You need to make a very, 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 very specific and solid trades to make any kind of profit. If you miss, you're going to lose the majority of it. Since you have to go all in on every single trade to make a profit, you have to hit the bullseye. If you don't hit bullseye, you're going to be like, oh crap, I screwed. So you have to be like a sniper. Make sure you have solid trading strategies before you place your trades, and you come up with a solid trade thesis, to place your trade, because every time you place a trade, you only got one bullet. You have to make it count. Last advice, come with solid trading strategies. You need to make sure that you use, I don't use a lot of indicators, but I know a lot of people, they're famous. People use, I don't know, like RSI, I don't even know them. They use a lot of, if you use that, it's good. It's good for you if you use them. I don't personally use them. And just come up with a solid trading idea, whatever tool that you use, because that's the most important thing, is to have to come up with trading ideas to execute your trades, And also the other thing is, also you have to leave your ego at the door. If you're just out here to try to flex your gains, all that kind of fun stuff, it's fun at first, but sometimes use it to motivate yourself. But you're gonna get crushed. If you have a big ego, you'll be like, oh, I'm not going to work. Eventually, at the end of the day, even if you make a lot of mistakes, even if you blow up your account, things like that, eventually you will get better. You will get better. I promise. Everything gonna be good. If you have any questions, you join the Discord group. If you don't have Robinhood Discord, Robinhood Webull, link in the description. Subscribe, and also watch the entire season from episode 1 to 12, because I'm sure this video explained to you exactly some of the terms that I've used on those videos, so you'll be able to understand me when I was reviewing, when I was doing recaps every single week. So thank you for watching, and I hope you good luck.